Hi, everyone. My name is Jeff Anthony. This is my colleague, Jason Fial. We wanted to thank you for taking time out of your busy days today to have our outlook for 2024. We greatly appreciate it. I'm going to pass this over to Jason to give a quick intro overview of our firm, and then we will rolling into today's presentation.
Yeah, thanks again, everybody, for being with us. Again, my name's Jason Fial. I'm an investment advisor here with Wilde Wealth Management Group. I've been with the firm for about 6 years. Jeff Anthony is going to be my counterpart today. He's a partner of the firm and has been with the firm for about 5 years now. So again, we look forward to providing you guys with a market update that you can take some items from and understand kind of what we hope to see here in 2024. Before we do that, I want to give you a little bit of background for those of you who are newer to Wilde Wealth about us as a group, our leadership, etc. So Trevor Wilde, as you can see, is our Chief Executive Officer. Again, where Wilde Wealth Management comes from. Trev's been an amazing leader of our group. Happy to be affiliated with him in this organization. His counterpart is Jackie Yoder. She's been with the firm for about 5 years. She's the Chief Operating Officer. Jackie helped kind of put everything together, and she's the glue to make sure that things run smoothly within our group. Janine Lackey is a Chief Compliance Officer with the firm. She's been with us for about 16 years. She makes sure that everything that we are doing is suitable at the highest level for you folks, which is very important, clearly, from an investment perspective. Yep. Then again, Jeff Anthony here, who's a partner with the group. For those of you who aren't familiar with kind of our size and our span, we have about 9 different offices, and we're in 3 different states. So as an organization, we hopefully have a footprint where there's an office that's local for you should you need to come in and have conversations, speak with your advisor, drop off documents, etc. Yep. Besides Wilde Wealth, we also have affiliates. So these are advisors who are part of our group, but they don't fall under the Wilde Wealth brand. So they brand their own names, but they are part of our organization and are very strategic partners, help serve clients just as we do. Another piece I think is very important, and I always recommend when new clients come on to look at our website to see all the services that we offer. Obviously, as a wealth management firm, our goal is to help people with their finances. That doesn't just mean money management and debt management. There's other things, other services that are tied to financial planning in general. So we do have a part of our group called Wilde Wealth Insurance that helps people with property casualty insurance, insuring their businesses, auto, home, etc. We have an affiliate that does college aid planning, JD Wyzalik. Mike Patinella is an in-house CPA with tax planning. Casey Taylor is a realtor and mortgage broker. So for your home financing and just home needs. We have an estate planning firm, Phelps LeClaire. They've been in the Valley for decades. They're great to work with from a wills and trust perspective. And then Lisa Martin helps with health insurance, Medicare, things of that nature. So these are all affiliates that we don't own, but they effectively own their own businesses, but they are vetted partners that we feel comfortable introducing to our clients should they need services in those areas.
Some of the accolades I wanted to touch on, we wanted to thank you first and foremost on this. Some of the achievements that we've had, and if you've been with us for a while, you know that one of the big things that we do is we always put our clients first. And part of the recognition is that because of what you guys have provided for us. So wanted to thank you for entrusting us with your money. On the left-hand side is the achievements that we've been awarded back in 2023. So again, ranked top #1 on Barron's lists and #2 on Forbes. So we thank you for that. Also wanted to touch on some of our newest advisors that have joined the firm. Andreas Favela, he joins us in our Scottsdale office. Josh Rushing as well in our Scottsdale office. Nicholas Bear in our newest office out in Surprise. And then Pete Crimmins joins us in our Mesa office as well. One of the biggest things that we look at and we get a lot of fulfillment out is giving back to our charities around the Valley. Some of the big ones you can see over here: Arizona Tuition Connection, Phoenix Children's Hospital, the Castile High School Boys and Girls Club. one of the biggest pillars for us is being able, because we are so fortunate to be able to give back to our communities. So we just want to make sure that we play an integral part on that to invest back into our communities to make sure that everybody's lifted up. One of our initiatives, it's actually Jason's very close to as well, is that we have going on right now, if you'd like to participate into it, is Mom's Pantry's Food Drive. So again, we're taking right now charitable or perishable foods. You can drop those off at any of our locations throughout the valley and all of those. And we also have an Amazon list as well. So if you haven't received the email from us, please reach out to your advisor. We'd love to participate into that and give as much back as possible.
Yeah, one other thing, Jeff, too, is so Trevor is very big about giving back. That's why he created the 501c3 Wilde for Arizona, so that you can see with some of the recaps here the different organizations we've touched with your help, which we appreciate very much. This will change every quarter. So essentially, we will rotate and find an organization in need that we feel strongly about. And so the first quarter is Mom's Pantry, which is a food drive that's affiliated with the church that I go to. So it's a great organization, but that will be for Q1, and then they will change every quarter. So we do take this part very serious, and we appreciate all the donations that you folks have provided over the years.
Yep. So pay close attention to your emails, because we do send out the email notifications every single quarter with the new organizations that we work with. So, all right. So with that being said, we wanted to jump into the presentation today. One of the things we like to do is recap on what happened last year, kind of give you an idea. It's always fun to look back and see, what our expectation was at the beginning of the year, how it kind of played out. Did it play out according to what we thought it was going to be? Or did we kind of shift gears there? And that was kind of the theme for last year. I know going into it, the chart shows this. Didn't matter which economist, it was either bad, worse, or ugly. And that was the overall trend that we saw in the markets, right?
Yeah, that's kind of what happened in the beginning of the year. So when you look at markets historically, a lot of times you run from the crowd, right? So the noise says X and maybe it's Y. And so 2022 was obviously a really bad year for the markets, where everything was down double digits. Equities were down 20 to 30%. So usually when that happens, historically, what you'll see, as long as there's not a deep recession on the horizon, you'll see markets kind of rebound, right? But how quickly and when, nobody knows. But all of the sentiment was, 2023 is going to be a bad year, et cetera. And then you wake up a year later and you see really good returns. So it's always important to stick to the plan that you have with your advisor. We will make changes when we see fit with your blessing, of course, but sometimes the noise is just noise, and it's not always accurate.
Yeah. And that's one of the things that we like to articulate, and hopefully we come across that way in our meetings, but we really like to be data driven on this standpoint. And again, as the data changes, we adjust with the markets there. So Jason and I were talking about this prior to coming on this, but we thought this was kind of funny. We had like this part of the slide with the Sam Bankman-Fried. Yeah, I keep on saying that wrong. Yeah. But again, this was one of the articles that was published in Fortune, which was he was going to be the next Warren Buffett. And this kind of plays into kind of what we do. There's a lot of different strategies that come across our desk, and we know that you entrust in us. Obviously, a lot of this is your retirement. You've worked your entire lives for it, or are building towards that route. And this is a perfect example of being able to trust who you invest with, and having a trusted advisor that can vet out strong and sustainable investment philosophies for you.
Yeah.
So it's not always going to be the next new shiny object, which, there's nothing wrong with some of the cryptocurrencies that are going in there, but making sure that you're position sizing on this, because the last thing that we look at is from a risk perspective. We just don't want anyone ever going backwards.
Yeah, no, I agree. And so with Sam Bankman-Fried, he was the poster child, and now he's in prison, right? Yeah. So you've got to be very careful. And I always tell clients, do your due diligence before you hire somebody, and make sure that you're comfortable with working with them for hopefully a long period of time.
Yeah, exactly.
Okay, so pre-election years, amazing how well things played out. Yeah.
This is always a fun topic.
It is. So it's an election year, right? And I think what's always a challenge from an advisor's perspective is some people feel strongly about one side of the aisle, right? And they will then cause their thinking to change in terms of how they want to invest. And we always try to caution against that because you want to be in the market long term, and markets will smooth themselves out over time. But what this kind of shows is, how do stocks do on a quarterly basis based on presidential cycles. So this data essentially shows from 1950 to 2022, so effectively 18 election cycles, how have markets performed. And so the blue bar effectively shows per quarter in year 1 through year 4 of the election, right? That the president being elected, what are the returns? And then the diamond shows the likelihood that markets are higher, the percentage. And as you can see, there's not really much of a rhyme or reason here, right? A lot of these charts that we show, it's not like an even checkerboard. It's up and it's down. And what this tells you is in some quarters historically, it seems that markets do better, but we would never recommend that you try and shift your strategy based on that, because it's very challenging to do so and do it right consistently.
Right. I mean, when we look at this kind of stuff, and you can take even looking back in most recent years, going over the last 20 years, if you would have gotten out during any of the last elections, regardless of what side of the aisle that you fall on, the markets did well under every presidency. So, the fact that, and this is one of the conversations that we have, I mean, we try to leave emotions out of the investment process as much as possible. Yeah. Obviously, we take into account your risk tolerance, which is extremely important, as we'll get into in later slides, because you got to make sure that you stick to your plan. And that's always the biggest thing. Put a plan in place and you stick to it. The whole purpose of having a plan there is so that way when you don't stick to a plan when things are going easy, because that's an easy part of it, right? It's when things get rough. That's when you just, keep your head down. We plan for this. Markets go up and down. But we've looked at a lot of data going back over the last 120 years, and it doesn't matter necessarily who gets elected during that, whether it's a split House and Senate, what the Congress makeup looks like. And we, ask your advisor about that. We'd love to share some more additional sides with you. But at the end of the day, like Jason said, it's time in the market, not timing the market. And that's really, really important.
Yeah, I agree.
Yeah. So diving off into the next piece, one of the things that we like to look at is obviously kind of coming off of last year, everybody thought that we were going to be going into a recession. The markets were extremely resilient. One of the big things that we look at is the fundamental indicators on this. So one of the biggest drivers of the stock markets is earnings, right? So when we look at earnings and moving forward from this, we do see earnings expansion, which means companies have done a very good job over the last couple of years of trimming their overhead, right? So they've gotten very lean. It wasn't necessarily about who could sell the most. It was more about, okay, can we pad the bottom line because we were a little bit more fat on that side.
A lot of the tech companies did that, right?
Right.
I mean, if you look at a lot of the big tech companies, they trimmed down 10 to 20% of their workforce.
Right.
And their stock prices did well, not because revenue was growing. It was
Right.
because we were becoming leaner, right? So that's earnings drive typically profit margins, which typically drive stock prices, right? So that's the expectation this year, as you can see on the left side of the chart, that you're looking at earnings increasing, in 2024. And the other piece too, I think is important. It's easier to kind of quantify and understand is margins, right? I mean, you can sell a lot of something, but if your margins are narrow, then there's not much profit, right? And so what you want to see is margins inching higher, and you can see that with this slide that margins are picking up, and that's a good thing, right? Part of that is because you've got some of the excess fat that was trimmed off, and now you also have revenue that we expect to reaccelerate this year, which will help margins jump higher, which again is typically good for profits and stocks. Yeah,
I agree with that. And I think that as we get kind of closer to coming out of this tunnel of the bear market that we've been in, when you're looking at this from a CEO standpoint and these big companies, they're not looking at making additional investments when they think the next 6 months is going to have a poor outlook. I think a lot of that is behind us now. And so they're able to make capital expenditures or capital investments into that, which is, again, going to continue to accelerate both of these charts up to the right-hand side, which is really important.
Yeah. Advantageous for the markets for sure. Okay, so amazing how well things played out. So again, back to the election piece. Apparently, I get pegged with here. So, so what this shows is, and data sometimes can be very hard to look at because there's so many different data points, right? But so election years do much better under a new president, right? Now this very well could be a weird cycle because it seems like both the people that'll be running were prior presidents, right? But ultimately, what this kind of shows is what are the returns when you have a lame duck year, right, where no one can be reelected, which we're going to be running into here. And effectively, what it shows is, and typically year 3, as you can see, regardless of who's in office, usually is the best year for the market, which occurred last year, by the way, which was year 3, right? But the trend here basically shows when you reelect a president, the market knows what to expect. And that's the key with investing is the markets don't like the unknowns, right? Think about it from an investor perspective. If you're an institution and you're trying to invest capital and you don't know what the laws will be or what to expect, it's really hard to invest, right? So what it shows is early on when you reelect someone, it's kind of status quo and markets do well. Then on the flip side, if you reelect someone new, typically it takes them a couple of years to get their agenda through, right? And then you'll see returns on the back end. But the whole goal, and we, as Jeff said before, that we have so much data to support this. Politics aside, markets, when you are in it long-term, do well. And there's so much data points that show it doesn't matter who the president is. Ironically, a split Congress and president do the best, right?
Yeah, absolutely.
And it's gridlock, and that means nothing gets passed, and sometimes that's a good thing, right?
Is, yeah.
So that's kind of what this shows is, again, there's not a lot of rhyme or reason, but ultimately kind of the known is better for the market than the unknown, and we'll see how this election cycle shakes out as well.
Yep. All right, and one of the things, and actually I'm gonna let Jason tackle this because this is one of his fun slides that he has. So
yeah, I like this. So things to remember, right? So when you look at equities long term, the average is around 9%. Now we have large cap stocks, international, and small cap. They're all different, right? But you blend them all together, you typically get a 9% return. So sometimes as an investor, we think, well, if I'm in stocks and the average return is 9%, then I should see my account just kind of incrementally go up at 9%, right?
Everything's going to be linear.
Yeah, and I wish it was that way because it'd make our job quite a bit easier, right? It's not, though. It's never easy, right? So what this shows is data from 1950 through 2022. So really over the last 72 years. And if you look at the gold bars, it basically shows when you've had around a 9% return, which has happened 4 times out of 72 years.
Yeah, which is pretty crazy.
It's a 5% probability, which means, to quantify this for you folks, that means 1 out of 20 years that you're invested, equities, if you're a stock investor, should return the average 9%. The other 19 years, it's going to be all over the map, right? And another tidbit too, and you can see some of the blue bars where you just see really, really bad markets, right? But sometimes when you go through the year, and last year was a prime example where markets did well to start, and then we had a really bad summer and markets were down, right? And then they rebounded the last 2 months of the year. The average inner year decline, even when markets are positive, is negative 14%.
Yeah, that's the average.
So you get a lot of volatility in the markets, right? So again, the idea is you have to be strategic. You have to have a plan with your advisor. You need to stick to it. We will make tweaks when we have to, but we don't throw out the plan because the markets did well or bad, because it'll change monthly, quite frankly, right? So understand that, when we talk about average returns, it's not your portfolio is going to typically return that amount. That's just on an annual basis, averaged out over many, many years.
Over a long period of time.
Right.
One of the things that, very interesting fact that I share with a lot of my clients is, looking at these long-term charts, assuming that you're getting a 9% rate of return, if you miss the top or the 10 best days over a 20-year period, your 9% return gets cut into a 4.5% return. So, which that's 10 days. Think about that over a 20-year period. Yep. So, when and last year was a great example of that. The last 6 weeks of the year, like you said, just went rip roaring. And, if you were positioned too conservatively, that was very detrimental. That's where the majority of returns came from.
Right.
So, going into the recession sign. So, this kind of playing into, are we going into a recession? Are we not going into a recession? And it really just depends on, I guess, where you get your data or your news source from, or your data source.
And or were we in a recession
Right.
last year?
Exactly.
It's tough to tell.
And also how you quantify it, right? So I know traditionally we look at, 2 negative quarters, which we had that going back into 2022, the first 2 quarters. But again, when they looked at the data behind it, they started to quantify it differently. So when we look at recessions, we're looking at these things and we look at main economic indicators on this. We're looking at different parts of the markets, different parts, like the consumer is the biggest part of GDP. So when we look at the makeup, and gross domestic product is what our output is in the US. And when we look at this, 70% of that output is consumer consumption. Everybody's pretty well versed on this, that the US, we're big spenders here as Americans. And that's just the way that we are. We do output quite a bit. We're good on technology, but our economy is really built on us spending money, which we've done fantastic, especially kind of going through this.
Yeah.
What I think a lot of people underestimated was how strong the consumer was and their aptitude for spending. And again,
I don't think there's any question about it, right?
Yeah.
And that's what the Fed underestimated too. And they
Yeah.
pretty much stated in their last few meetings that we underestimated the strength of the consumer. And part of that, as you see on this slide here, that it shows household balance sheets are strong, right? And that's based because of rising assets and stocks doing well last year. And real estate, even though we're in a weird real estate kind of situation, real estate continues to climb up. So from a household balance sheet perspective, consumers have more confidence when you see your assets going up, right? And I think that was hard to fathom in 2022, but now as we come out on the other side, the recession indicators and most of the recession hawks are gone for the most part.
And we're looking at a Fed now that's just trying to methodically decrease rates now based on the data that comes through. And we'll touch on that in different sides, but that's again, one of the things that they're looking at is, I don't think it's an all clear. And it's one of the things that we like to stress is it's not that we've avoided a recession. Recessions are normal and they're necessary. You have to have them to reset. So I think this just prolongs it. And it's not like I said, whether it's a year, 2 years, 3 years, they usually come, the economic cycles are usually 3 to 5 years or 5 to 7, depending on, which data that you look at.
Yep.
But when we look at the data today, like everything's looking pretty decent.
Yeah, I would agree.
Yeah. One of the other areas that we look at, which is a huge part of it, is the labor market's still strong.
Yep.
We've talked about it. They conquered inflation from a standpoint of, we were at 9.1% last year in June, which was like the absolute peak. The latest numbers that we got were 3.4.
Yeah.
Well, everybody was seeing a significant increase in their pay, right? So we saw wage growth peak out at 7% year over year. But the problem was that we had, wage growth at 7, but then you had inflation at 9. So your real raises weren't actually there because the cost of goods were eating that up. Well, now we're actually seeing it where wage growth is up 4% and inflation's at 3.4. And the labor market has been extremely strong. When you look at some of these, we're still at 50-year lows on the unemployment side.
I think the last data was 3.7%.
Yeah.
And that's one thing I've always tried to stress over this weird kind of economic cycle, at least we were in 22 and most of 23 was, there's so many indicators to look at, but sometimes you just look at, do people have jobs, right? If people have jobs, then they can spend money, they're getting paid.
Yeah.
If they're spending money, they're buying products. If they're buying products, companies are selling products. If companies are selling products, then there's profit, right? And stock prices go up, et cetera, right? It's when you have a big decline in the labor market that's when things fall apart, right? And that's not been the case. And the Fed's admitted that, but it's been a good thing because they've been able to kind of thread the needle and navigate where we can bring rates higher to slow things down a little bit, to bring inflation down, which has come down significantly. It's still there, right? Yeah. But it's coming down, but it's not hurt the job market. And as you can see in the slide, the prime age employment ratio is because it's been in 2 decades, which is good. We want people in their prime years because they will be working longer, right?
Yeah.
And that's good for the economy long term. So this is just more inflation is falling. Jeff kind of touched on that too. And there's different, I don't want to get too technical here, but the slide will show, core PCE and core services X housing and all of that. There's lots of different things. The Fed's preferred measure is the PCE inflation, which now is under 3%. And we think the indicators show it it can drop significantly here over the next 3 to 6 months. The Fed targets 2. But all these data points show that, and if you look at kind of the graphs, it's pretty easy to see that things are coming down for the most part. And that's helpful, right? Because again, the key is, as Jeff said before, you can have raises, but if the cost of goods and things that you purchase are running higher, then you're negative, right? And so now we're in a sweet spot where wage growth is still doing well, but you're seeing inflation come down, and energy prices are coming down, which is great. That wasn't expected, but that's been a nice surprise. So there's been a lot of disinflation in lots of areas, and these charts speak to that.
Yeah. And you got to remember too, I know that, probably some of the conversations you have with your clients, things that, used to cost a lot less 3 years ago or 4 years ago are still, pretty high up. When we're talking about like stock market investing though, it's you got to look at everything from a 12-month or a 3-month time period. So to Jason's point, when you see when you see the areas or these charts declining, the stock market is very different than the economy. So as Jason was saying, that as things are coming down, that's really the biggest thing, is the stock market and the economy are going to be sold and separate. And sometimes you'll see these divergences going through. So the whole point to that was, it's just, when we look at these charts, that's very good because that really plays into our investment philosophy. It might feel a little bit different on the personal side, right? If your costs are still high at the grocery store or you're going out to eat, it still seems like it's very expensive. The stock market looks at everything from a linear standpoint, and they're looking at a 3 and 12-month time period.
Right. Yeah. So strong incomes equals strong consumption, kind of the same trend that we've been talking about, right? Yeah. So you've seen wage growth go up well, and this kind of shows real incomes continue to rise. So again, real income is the income, the wages, the increase in wages that you're receiving versus the inflation rate, right? Mm-hmm. And we want that to go up, right? And that's a good thing because, again, as we talked about before, we're a consumption economy, right? And consumers generate 70% of the growth in this economy. So, in a perfect world, what you want, and it's kind of occurring now to some degree, is you're getting wages that are growing, right? And you have inflation that's coming down, right? And that's what you typically want. That's a healthy economy. That's how things look today. Right. Let's hope they continue. And consumer spending is still running above trend, right? And that's, again, just the resiliency that we talked about before with the consumer is people are still spending. I think they're being smarter on what they're spending on, but they're still supporting growth in the economy, which, again, helps supports GDP growth and companies and their revenues and their profit margins, and it's all connected. So it's a good sign.
Yep. All right. And then kind of going back to kind of aggregating the last few slides, price stability. And when we're talking about the Fed, and this is going to be more specifically to them, the stock market got a lot of so kind of rewinding a little bit to last year. In February, we started having some of those mini bank crises, right? We had some bank failures. And then in March, that was kind of the opening up of the artificial intelligence, or AI is what you'll hear us refer to it as. That really stoked a lot of optimism in the markets. And then kind of going into the end of last year, we really saw a pretty steep decline. We were getting down to that 3% area on the core PCE. So that's going to be your consumer price index. And that's the rate of inflation that raises or lowers year over year. And when we're talking about this, the Federal Reserve has a mandate. They want full employment and they want stability of pricing, meaning that they don't want goods and services going up by 9% every year. They want it at 2%. So they have the full employment there, which that's one of their metrics that they're looking at. And then the other side, again, is the price stability. So when we're looking at this, once they start achieving these goals, and this is, again, what was one of the tailwinds that you'll see in the markets, they're going to be able to stop, they've already stopped raising interest rates. I think we haven't had a rate increase for 6 months at least. And the other thing they're going to be doing, though, is they're going to start cutting interest rates. So they've given guidance this year that they're going to be cutting by about 0.8% or 80 basis points. And what that does is that really helps out a lot of companies as far as if they need loans, or even on the consumer side. Remember, we're a consumer-driven economy. So when they're raising interest rates to the level that they're at, they're making cars more expensive, credit card payments are more expensive. All of the things that we use financing for your money doesn't go as far. And that's their metric of allowing things to slow down. So you can't afford it. Your dollar just doesn't stretch as far. And so you consume less. And then that's how they're able to stabilize price. And they're accomplishing that. I think they're doing a great job.
I would agree. And I think an example I use with my clients a lot is with interest rates, right? And they're higher and they're lower. And how does that really affect me? I think, Jeff, you touched on it pretty well. But most of us own homes, right? I mean, we were in a weird cycle where from really 2009 to 2022 for 13 years, I mean, mortgages were 3 or 4%, right? We've never seen that before, which is why housing is in a weird spot. But essentially, if your mortgage is 4% and you buy a $500,000 house, it's a $20,000 interest commitment, right? It's 7% today. Right. So you're effectively financing the house at $35,000. It's almost twice. Right. So think about how much house you can buy today at 7% versus 3 or 4%. Right. And this works on a much larger scale with companies. Right. In terms of when they have to borrow money, if they can borrow at lower costs, it helps them achieve the financing they need to hire and to buy product and things of that nature. And their profit margins are better because their borrowing cost is lower. So the hope is, the Fed will start cutting rates this year, and that should be a tailwind for the economy because you have less pressure on these companies now. There it is. So lower rates can be a tailwind. I guess we got to
keep on bursting the bubble.
You did. So it's kind of the thing that we talked about here. Now, one piece though that I think is important that's been helpful with some of the economic growth has been some of the fiscal policies that were passed a few years ago. So we had the Inflation Reduction Act, we had the CHIPS Act, and those things are helping with manufacturing and just growing the economy kind of wider out, right? And that's helpful, and that's also helpful when you have lower rates too, because you have the fiscal stimulus and they can borrow it at a lower cost. So you can see here kind of the residential construction booming despite high rates, right? So rates are higher, they are going to be coming down, which would be better for residential construction, but part of that's been helped with some of the fiscal policies that have been passed. So they kind of threaded the needle, whether it was done so on purpose or not, to where even when rates were high, it didn't hurt the economy based on some of the fiscal stuff that was passed as well.
So and that's a great way of kind of putting it. It's just one side of the government working on one objective, and then you have the other side of the government that's working on the other. Sometimes they're not in tandem together, which is kind of counterintuitive sometimes,
which is typical of government.
Right? I mean, but that's the reason why you've seen the deficit go up so much. And then, that's the other thing too. We kind of have golden handcuffs on the interest rates because our debt's grown so much, and it's at what 34 trillion the last time we checked. And so we have to pay. There's a debt service on that, meaning that all those interest payments, and we have this in our clients' accounts. We own treasury bills, so that's money that you lend to the government, and they pay you back a fixed amount of interest. Those rates are very high, and they have to service those, and they service those with our taxes. So that's one of the other reasons why we can't maintain these high rates forever.
Right. That's exactly right. So productivity, Jeff touched on this a little bit when we talked about just technology and artificial intelligence, right? So what this shows is, so essentially what the Fed's goal is when you have inflation that's at a too high of a level to sustain, right? The goal is, how do we bring consumption down? Because inflation just supply imbalance, right? And if we can bring consumption down, then the pricing comes down, right? And that's what they were trying to do, and it worked out better than I think they expected. The point being, though, is they didn't have to hurt the labor market, and wages have still grown at a level because productivity has gone up, right? And that's what's key is you can pay some. I mean, think about it. If you're paying someone to do a job, right, you can pay them more if they can get things done quicker, right? And it's the same thing on a macro level here, where you can see, if you look at the chart, productivity has gone through the roof, right? If you look over the last 50 years, and it should, because now we have cell phones and we have all the technology, right? And artificial intelligence, even though it's in its infancy stage, is going to be key, right? It's going to help companies become so much leaner, much more efficient, will help profit margins, and each employee that's hired, their productivity level goes up significantly, right? And that will help, and we're seeing that now, and I think it'll continue to grow.
Yeah, I 100% agree, because it's, it's one of those things, like just with we kind of look at this like the evolution of the internet, right? Everybody thought that the internet was just going to be like, not necessarily a fad, but not something that's going to be anyway integrated like it is today.
Well, yeah, think about dial-up, right? In the 90s, like
it's crazy.
We're not doing that anymore.
No.
So it's different.
Yeah. And so we think the artificial intelligence trade or mechanism that's going to get integrated into this, it just creates those efficiencies. It's able to aggregate data faster, whether we can automate certain procedures and really help like some of the day-to-day stuff that's just kind of a drag. They might be able to create some efficiencies and just create that better productivity like it's shown in this chart.
Great. Yep.
All right, so things to always remember. And then the biggest thing is, and again, we've gone through this, it's, it's not necessarily timing the market. It's based on time in the market. So the longer the period that you hold this, and this is what this whole chart shows, the longer the period that you keep your money invested in the markets, the more likely you're going to see gains. So you can see daily, obviously it's a coin toss, right? And then you scroll over to basically your break even on this is, and this is if you were 100% in stocks, right? So not a lot of us are going to be all in on the equity side. If you actually look at this on a 5-year chart, so it shows the S&P 500 here, 80% of the time you would have been positive. If you're in a balanced portfolio, that's almost 100% of the time. So you can't necessarily say 100% because of probabilities, but you look back over the same exact time frame, and we look at rolling periods, it does the same exact thing. So our whole big thing is, yes, there's like volatility is necessary. It's normal. We need it to kind of regulate the markets as far as making sure there's not bubbles. And that's essentially how the free market works, right? That's capitalism. But this just kind of shows you if you stay invested in the markets, you're going to be a winner.
Well, and I think too, what's important is we always try to stress to our clients, I think every advisor that I've spoken to here at Wilde is, if you're looking to put money somewhere and then you want to take it out in 6 to 12 months, you shouldn't be in a market-based account, right? And that this bears that out, right? Because if you want to keep it in for less than a year, there's a 70% chance you'll be up, but 30% you'll be down, right? So it's more, if we're going to be investing in equities, it's a multi-year strategy, right? Now we will change what we're investing in over that time, but you've got to be committed to investing long-term. And if you do, then you can see over multi-decade periods, there's, at least in the past, a 100% probability that you'll be positive. And that's the goal.
Yep.
And volatility, as Jeff talked about, right? So things to remember, stocks might go up, but they can also go lower, and there's lots of volatility. Bear markets happen. So this is a neat piece, and I talk to my clients about this a lot, right? And volatility is the toll we pay to invest. So what this basically shows is this is looking at the S&P over the last 72 years. This is on a per year basis. So what this basically shows is how often do you get a 3% market decline with stocks? Well, it happens 7 times a year. So really every other month, right? How many times do we see a 5% correction? Well, once a quarter, right? And then a 10% correction. It happens annually, as we talked about, a 14% intra-year decline. Look to the far right, and I talk to clients about this, and it kind of catches them off guard, but basically every 3 years, there's a 20% correction if you are all in stocks. So if you have $1 million portfolio, you can expect to lose $200,000 every 3 years.
On paper.
Right? And so you wonder, well, if that happens, how do we make money back? Well, there's volatility, and if you're doing the right thing and you stick to your plan, you'll make it back up. But it's key to understand that if you are in equities, there's lots of volatility. And if you use the volatility to your advantage with the right plan with your advisor, you can actually do well because of it. But it's always important to explain to clients, like, if you're in equities, like it's going to go up and down quite often. And sometimes there's sizable losses that you have to understand will occur at some point.
Yeah. And I mean, this even catches me off guard a little bit, like how often the 20%, like it's pretty crazy.
It's very, I mean, it's consistent.
Yeah. And sometimes those 20% happen in a matter of 6 weeks and they're fully recovered. Sometimes they take 24 months.
It could be a slow bleed. Yeah. It depends.
Yeah.
Sure does.
All right. Well, we wanted to thank you all so much for attending our halftime show this year. We'll be having another one in probably 6 months.
Yeah, it's 6 months, and
Yeah.
So I think the goal was hopefully some of the information we provided was helpful in terms of kind of where things were in 23, what the expectation is moving forward. And as we always say, this is more generalized, right? If you have specific questions about your needs, your portfolio, et cetera, contact your advisor, schedule a time to chat with them.
Yeah.
And it should be more of a personalized conversation. But we sure hope this was helpful and give you guys some key metrics to understand and consider for 2024.
Yeah. And thank you so much for, like I said, taking your time and trusting us with your money. And we greatly appreciate it.
Yeah, very much.
And you have a great rest of the day.
Yeah. Thank you much.
Thank you.